1 p.m. on the East Coast. You could tell that Dan, Nathan, and I are together here at the studios of Current. It's like we're just rocking it. It's like, what is this called, Dan?
IRL.
IRL. It's IRL here on Market Call, 1 p.m. on the East Coast. This Market Call, Dan, brought to you by CME Group. Ooh, I was about to say something else. Where risk meets opportunity. Of course, our data provider is FactSet. How are you, Dan?
I'm doing well. This is kind of fun. I feel like we're just kind of like in a point counterpoint situation,
like the McLaughlin Group.
Oh yeah, that's what that was a fun show. No, it wasn't.
I like that show because the old dude,
they were all angry. Old dudes, and they were all dudes, and it was just a bunch of gray hair.
There were some women involved in that.
I don't know.
A bunch of great, but I think he passed away, so it's no longer the McLaughlin Group.
Yeah,
but it's an interesting day in the market today for sure.
Yeah, no doubt about it. I mean, it's funny. You know, I actually did something. We're gonna talk about some trades. People like the trades. We get good feedback about the trades. We'll do a couple option trades today. We're gonna do a futures trade in the crude. You know, I've been kind of dogging this NASDAQ, and I came back from vacation a couple weeks ago. I made this proclamation that the NASDAQ is the fattest pitch out there. It didn't work so great last week on the market call. It was Tuesday. It was a CMED. We talked about trading futures in the NASDAQ 100, and we used a fairly tight stop at that kind of 13,000 level. We got stopped out. We're still above that level. And I tried kind of moving into some other products there, some options, some ETFs, that sort of thing. None of them are working. Why? Why is it, Guy, that mega cap tech is just levitating here when we're going to hit the banks? We hit them yesterday. They don't act particularly well. We got a lot to talk about them there.
No, I think we've talked to the reasons why. I think one, it's a flight to perceived safety, sort of, I guess, economy resilient type names, which I don't believe necessarily. Yeah. I think rates going lower for whatever reason seems encouraging the market, whatever the market means in these days. But we've seen it before where that's typically the last sort of bastion of hope before everything rolls over. And the broader action today, I don't think is particularly great. And when you see names like Caterpillar rolling over, Deere rolling over, these very manufacturer sensitive, economically sensitive names, on top of which you mentioned the banks trade, and we've been talking about this now for a while, they trade awfully, and that's not particularly encouraging.
Well, you know, it's interesting. You know, I was looking at some of these regionals right out of the gate that are down, and you know, if you look at this FRC, this First Republic chart, which is like next in line after the SVB, I mean, this stock is down 80-some%. It's flatlined over the last week and a half or so, and it looks like someone's just in there buying it at this 13.5 level. Why would you buy the equity of a company where you know if a bailout comes or some sort of backstop, the equity, and they just proved this, was that SVB is going to be predominantly wiped out, right? Like, and in that case, it was all wiped out. And Signature Bank was why would you be buying that? So that's the 1 year. If we could look at like a 2 week or something like that, it's just flatline down there.
I think people are trading around it. I mean, the only natural buyers.
Are they good at this or what?
I don't. Their art group is unbelievable.
You and I are in the same room. They're just working their FactSet terminal.
That's Jacob
here.
and Rafe is just killing it. No, look, if people are short the stock to the extent that there's still shorts out there, maybe that's part of it. I guess. People trading around it during the day, I guess. But I've said for a while that I do think you will see a take under in the space. Now, people have pointed out, wasn't UBS and wasn't UBS and Credit Suisse a take under? Yeah, I guess. I'm thinking something more here in the United States, though.
Yeah, you are.
And by the way, Schwab doesn't trade particularly well either. No. That's pushing down towards $50.
So it'll be really interesting to see when it's below 50. It had that one day, that panic day, where it gapped lower, it traded in a huge range, and then it was like a kind of spike bottom, and it came all the way back up to the high 50s. But here we are at 50. We talked about that Morgan Stanley downgrade of Schwab last week. I guess the thing that kind of irks me a little bit here, Guy, is that we have, you know, the major indices are kind of holding in there a little bit, but under the hood, there's a lot of really bad action. And then let's just talk a little bit about this Jamie Dimon, CEO of JP Morgan, his manifesto here. He put this little split screen out there of, you know, what he sees as the here and now right now. And I think it's kind of interesting. He basically has a bit more of a rosy outlook than he did almost a year ago when he was calling for an economic hurricane. But then on the storm front, or storm clouds ahead, and you see no shortage of potential headwinds. And this is what we've been talking about. And this is one of the reasons why, Guy, and we talked about it earlier in the week, I'm not dying to change my tune here, because the data, as I look at my FactSet screen and I see what's going on today in the market, it's screaming recession. The only thing is we got an S&P either side of 4,000 and people feel pretty good about things.
For now, they do. Yeah. But, I mean, all the names that you mentioned, all the reasons that Jamie cited, I mean, it's clear that that's where we're headed. And I'll say this, I think it's the Fed's almost want to get us into a recession. I mean, that doesn't sound intuitively correct, but I think that's exactly what's going on here. And I think you need unemployment to start to tick up. The jolts suggest that maybe it's going to start working for them. Fewer job openings we've seen for quite some time. So it's not encouraging if you're a citizen. It's encouraging if you're watching the data. So the market hangs in here. I get it. I still think a big function of it is passive investing, money flowing into the market. I don't think it's necessarily signifies anything bullish. But like on a day today, you see how quickly things can go down.
Yeah. And so Jamie's comments about, this kind of bank crisis, and I think he's echoing a lot of the things that you and I also believe. Whatever we're on the other side of this, let's just say those 5 failures, like that was it. I don't think that's the case. You don't think that's the case. It doesn't seem like Jamie Dimon thinks that's the case. But there's going to be, he used the term repercussions on the other side of it. And we're going to be feeling the lag effects of this for a while. Part of that is kind of tighter credit conditions, that sort of thing. And I think what's really interesting, we talked about Blackstone yesterday a little bit, their exposure to commercial real estate, their exposure to a lot of alternatives and a lot of other areas. I mean, that stock continues to act very poorly. So I guess if you're just focused on the banks that failed, and most of these banks that failed, most Americans had never really heard of for the most part. But if you also look at the underperformance of the major money centers and also the investment banks and some of these other kind of, what do they call them? Shadow banking sort of institutions, they don't act well.
No.
You know what I mean? And so at some point, the chicken's got to come home to roost. And one of the reasons why I'm stuck in this XLF and I keep kind of rolling down, whether they put strikes or shorting, I really don't think that the Q1 story is going to be particularly great, and the outlook is not going to be
Banks are the foundation of, really, if you think about capitalism in our society, our economy, everything is predicated on how banks are doing what they're doing. And I've said this, but I think it's worth saying again. Rates can continue to go lower from here. That will not change what's going on with the banks. Credit conditions are going to tighten by definition. Regulation is coming to a theater near you, whether you like it or not. That's going to obviously mitigate some of the bank earnings. So they're going to be under pressure. And at a certain point, banks will lead. The rest of the market will follow. And this perceived safety, again, today, a name like Microsoft, a name like Apple, I get it, but man, oh man, those stocks are not impervious to what's going on in the world. And by the way, those stocks have gotten themselves very expensive right before our very eyes. Microsoft specifically, which didn't really say all in that great stuff last quarter, yet here's a stock that's now going from 223. I think we're either side of 280 right now.
All right, let me paint a little picture for you when we get Q2 guidance, okay, in the next few weeks from some of these big platform companies. Just think of a Microsoft that has the public cloud Azure, and they have all these other services that like kind of obviously are across the whole economy, not just tech companies, right? Like who are using the productivity tools and pay the licensing fees for Office 365. And the list goes on and on, whether it be, Amazon's AWS has been decelerating fairly rapidly, right? From like over 30% growth to high teens right now. So think about all these companies that service all of these other companies that are laying people off. And then let's just say you were a customer of Silicon Valley Bank or one of these banks that just had the run and you're worried about your capital. All of a sudden, spending at a lot of corporations is going to go to a screeching halt here. So I just think of these companies that you think are safe havens right now. And this brings me back 20 years to the dot-com crisis. If you were selling, whether it be telephony or whatever, whatever the hell it was, the list goes on and on, servers, I mean, and to companies that are retrenching and they may go out of business, and you just had a shot across the bow, like these companies that were banking at Silicon Valley Bank, not just their deposits, Guy, it's also their access to credit, because that's what they were in the private credit market is a big thing. I just think that that's going to be reflected in Q2 guidance. So I don't think those places are particularly safe. JP Morgan, Marco Kolanovic, he's got a different tune. He's the head strategist over there than Jamie Dimon, his boss. Talk to me a little bit what Marco's saying, because I'm reading these headlines here, Guy, and this is exactly what we've been saying for a month.
And this is a guy that I think gets labeled a lot of times as some sort of perma bull. He's not. I mean, when he was bullish over the years, it was right to be bullish in retrospect, but he has taken a much different tact over the last 5 or 6 months. Now, maybe his timing wasn't perfect, but I think his work speaks for itself. And he's talking about, to your point, Dan, the exact same things that we've been talking about. Any decline in yields is not a sign that the Fed is about to bring the punch bowl for tech stocks. And I think there's a perception that that's what's going on, and lower yields are inherently bullish for these names. But I'll tell you what, you still got to go to banks for credit. And regardless of where yields are, if bank lending standards are going to be more rigorous and more strident, they're going to have a problem. So if you think about these tech names, they're highly cyclical, highly dependent upon the consumer and the economy, and obviously very capital intensive. And all three of those things are trending the wrong way.
Well, and those are the very repercussions I suspect that Jamie Dimon is talking about,
Sure.
right? On the other side of this crisis. Let's look at the S&P 500 chart really quickly here, because we've been drawing the
Through
lines.
the minis.
You see it. Yep. Through the minis, the S&P 500 minis. Look at that 200-day moving average guy down there at 39.50. It's kind of flatlining a little bit. You see that uptrend. There's just 2 points there, but it's fine. We're just above the downtrend for the first time in an awful long time. We're well above that 200-day. It seems like that was really good support a couple weeks ago. Flight to quality after the banking crisis was averted. My play is that we have a retest of that 200-day to the downside, possibly that uptrend, and who knows what happens from there. Talk to me on that.
Well, if you look at this, obviously, so if that's the trend line we want to look at, which it is, you say, well, we broke through, it should be bullish. Okay, that's one. You could also say maybe it's a bit of a failed breakout, and I'm looking at it. We traded effectively towards levels we saw back in February. So we got up to those, seemingly exhausted ourselves. So if we verse now through the trend line to the downside, one has to think that the 200-day moving average, which is resilient around this sort of 39.50 level, comes into play again. By the way, the same way that we had a false breakout through the 200-day, maybe this is a false breakout on the other side, on the upside. Now, I think the pennant is still in play to a certain extent, and it all comes to fruition right around earnings. Like, it's not coincidental that that pennant will form some sort of a point right when you start hearing from companies, specifically banks, which are going to lead off earnings season. And if you think, I'm hard-pressed to understand how bank earnings and the subsequent guidance can be anything but tepid, to use a favorable word. I would use the word shitty, because I think that's what's going to happen.
No, I mean, if you're a management, if you're a CEO, given all the uncertainty that we have right now, not just in our economy here, but globally and geopolitically and the like, why would you give like too aggressive outlook, especially when you consider how much of their earnings come from net interest margins and just the lending? And this is large money center banks. And given the volatility and yields, and we're going to get to that in a second here, just real quickly, the NASDAQ futures guy, just wanted to hit this here because, last week I detailed a trade way to short it using a stop. We were looking at 12,700. Initial target was down there towards 12,000. Okay, we wanted to stop it at 13,000. We got stopped out there. It's gone a little bit above that. I really do like this trade. One of the reasons why you use tight stops, though, is to give yourself the ability to go back in there. You just, take a bunch of small little losses, and then it starts going your direction. You did a great job kind of talking about trailing stops last week when it's going in your direction. But to the other side of that, you want to take small losses and get back in there. And you don't want to get chopped up too much. So you have to have conviction when you're doing this.
That's what futures allow you to do, right? And that's why we're looking at these. And as good as that NASDAQ chart looked, that the minis looked a couple weeks ago, that's as precarious as I think it is now. So now we tried to deal with, or at least challenge, the levels we saw back in August. Remember that move from June into August? Seemingly, and I'll say that seemingly, we've stalled out just short of that. So do we see a retest of the 200-day moving average here, which we've seen before? How do you trade it? I think you're right. When you start to feel momentum's on your side, that's when you put on that position, and you can add to it on the way down. And that's what futures allow you to do. And the stops, which everybody should trade with, as I mentioned last week, I think, or a couple weeks ago, you could start putting a trailing stop on the back of it. So that's why futures are so important. It gives you the flexibility, I think, and the wherewithal to be aggressive in this arena, which, by the way, I think is a great arena to be in. Tim Seymour talks about it all the time. It's a great trading environment right now.
It has been that. Let's look at the VIX really quickly. So this is a measure of the volatility in the S&P 500 here, and we're getting down to levels that we've talked about a lot. These are the high teens. That's been a good time to sell stocks. I just want to pull up. This is something I'm trading right now. It's the SDS. This is the ProShares Ultra Short S&P 500. It's an inverse ETF, and it's 2x the performance of the SPX to the downside. Now, these things, and I've talked about this a little bit before, I use these on a very short-term basis. If I'm looking for a move, to happen in the next day or two, there's embedded decay in these. That's how they get the inverse and the, the 2x sort of performance. So you just don't want to sit long these things by any means. But right now, I look at this chart and I pull this thing up. It looks a lot like the VIX chart. It's up here approaching, near-term support here. So that's something I'm playing for the short term here. All right, guy, let's do a trade. I just want to get your take. If you didn't watch Market Call yesterday, people, or listen to us, that surprise OPEC cut of 1 million barrels a day. It caused crude oil to gap higher, above the downtrend that had been in place from last year's highs at the height of the fear of the Russian invasion of Ukraine here. Didn't get to its 200-day moving average yesterday. It's trading within yesterday's range also too. Thoughts on crude here, because I want to take the other side of this near term. I'm going to use futures, I want to use stops, and I want to talk about levels, but I'm just curious your take on that as far as 24 hours later, the price action in crude oil.
Yeah, no, it's fair. And I think to take the other side at this point, maybe it exhausted itself yesterday. I'm still bullish. I will say I'm still bullish in crude. I still think we have a significant move higher. We had Paul Sankey on Fast Money last night, and he talked about the backdrop now setting up for a very bullish crude in a few coming months. Now, he was a guy, by the way, in November, I think, when Brent was $80, that thought we could see 120 Brent by the spring. Well, it's a spring, and we're obviously not there. I think we got a little bit north of 85. But he also thinks, given what's going on, suggests that the crude should go higher. I'll say this, though. If you look at some of the underlying equities today, and I see a couple comments, Guy Valero tanking what's happening. That's from Gary Maggio. If you listen to Paul Sankey last night, he actually said that move in crude was actually negative for some of these refiners, and he specifically mentioned Valero. He said you'd rather be in some of these levered names, and he mentioned a lot of the OIH. So Valero under pressure today. It's unfortunate if you're bullish that we were not able to take out the levels we saw earlier this year, I think north of sort of 145. I'm not ready to throw in the towel here by any stretch because we've seen moves in this magnitude before in some of the refiners. But I think your instincts are right to sort of trade it contra in terms of the commodity. But I still think longer term crude's going higher.
Yeah, so this is near term trade here, and again, I want to use the futures. And when crude's trading about $80 today, I want to use an 82 stop. So I'm going to short at 80. I'm going to use an 82 stop. Why am I choosing 82? It's basically right about the highs of the last 2 trading days. And then if you look at that downtrend, if we want to toggle back for a second of the chart that we just had there, it kind of lines up with the 50-day moving average. That was also Friday's close where we got that gap on Monday after the OPEC surprise cut. So that check back, as Carter would call it, back to that support line, which is past resistance, now support, would be my initial target. So I'm like looking for a $5 move down to 75. And at that point, I mean, you have the ability to kind of continue to move your stops down, that sort of thing. So we're using the May contract. That's what I'm looking for here. And again, I just want to use a tight stop. And, above that, if I get stopped out at 82, let's see if it continues to go to that 200-day moving average, which is downward sloping, and then that might be another opportunity, Guy, if it were to fail there, to get back in on the short.
It's interesting. And look, we've talked about when the administration is going to get back and try to buy back the SPR. EY from SoFi yesterday brought up the fact that they probably are not allowed to do it given what's going on with the debt limit and those types of things. I have no idea how that works. Or somebody actually texted me yesterday or tweeted at me that said, as long as you're releasing from the SPR, you then can't buy back into it or something like that. There are all these different mandates. I have no idea. With that said, they better get on the bus pretty soon. It's interesting. Quick comment, because this I think this speaks to what you're talking about. Somebody said, if you're bearish the economy, you should be bearish the IWM. So the small caps. I don't know if we can pull up a chart, but you've mentioned that there's been a market underperformance of the small cap. I look at it through the IWM. There are other ways to look at it, but I think they're right to point that out. I mean, there's been really no meaningful bounce here. Yeah, it bounced a little bit, but if you look at it in relation to October, not a lot has gone on vis-a-vis sort of the broader market in the form of the NASDAQ and the S&P.
Yeah, we talked about it last week. I mean, this one to me, and I know there's a lot of like smaller banks in the small cap index, but I just think that the relative underperformance to the NASDAQ and also the S&P, and I think it's really important to remember, Guy, back in late 2021, this was your indicator, small caps. Yeah. You said, watch it. You thought they were going to lead to the downside because these are the most economically sensitive companies in our country that have harder time with access to credit and the like here. So to me, I think that's a great heads up here. Let's go to this. We got to talk about yields, and we
Yep,
got to talk about
absolutely.
expectations, because Carter had a note out today, and we'll probably cover it a little bit tomorrow, that he wants to continue to press the 10-year yield. He thinks this goes back to 3. He's been on that train since it was 4. He's reiterated a bunch since the fall. CME Fed Watch tool here, Guy. We're looking at this May meeting and this June meeting, and it looks like it's a 50-50 chance that we're going to get to the upper bound of that 5% Fed funds rate, which is really kind of nuts when you think about where the 10-year is going and what that is reflective of. That's reflective of slower growth, and the Fed's at least this indication of where the Fed is going to move Fed funds to is reflective of the fact that they're still worried about inflation, which to me is a big shitburger of stagflation, which is not going to be good for stock valuations.
No, a lot of people are saying they're making a mistake, a generational mistake in terms of what they're doing now. And listen, the reality is, no matter what they do, it's going to be a generational mistake, because they put themselves in this position. If they were to cut rates in the back half of this year, inflation, that genie will get, first of all, it's already out of the bottle, will just continue on its merry way. If they continue to raise rates to try to fight that inflation, they're going to knock the shit out of the economy, which we're seeing now in the form of these ISM numbers we're seeing, and to a certain extent, the underperformance of the Russell. So they're screwed either way, which, people say, woe is them. They put themselves in this position. That's really what it comes down to. But I think you're right to point it out. By the way, somebody's asking about CrowdStrike before we have a question, if we can pull it up. And it's interesting. I think CrowdStrike, I'm looking at my FactSet machine, and they're due to report on or about the 1st of June. So you have some time. But take a look if we can pull up a chart, and if we can go back to like 2021. So if you see this, Dan, I mean, you can draw that line. We can't do it here, but there's obviously in this downtrend since effectively October, November of 2021. We've seen bounces along the way, and we're in the midst of one now. But my eye looks at that and says we're still in a downtrend. And until we break through it on the upside, you're probably looking to take profits here. I don't know if you're looking at the same thing I'm looking at.
Here's my problem with this company. It's $32.5 billion market cap. There's 43 buys. This is per FactSet, 5 holds, no sells, and the valuation is just out
probably
of
about
control.
10 times revenue is my sense.
Yeah, and it's just one of those things. It's just like, guys, okay, man, like, what did we learn from 2021? And I get it. Nvidia has gone parabolic. It's $100 above its 200-day moving average, which was just crossed over just a couple months ago, and it trades at 20 times sales and all this sort of stuff. I get it, but I listen, there's always going to be some of these remnants of like a bubble period. I think Crowd, even down as much as it is from its all-time highs, it's still a bubble name there. So, not something particularly interesting.
No, I don't think so either. I look at it's probably trading at 45 times next year's numbers. Understanding it probably has 24% or so EPS growth, but I think it's an expensive stock, and we've seen these names being taken out to the woodshed before. So my sense is Robert is long the stock. My inclination would be to be taking profits here. I think that's the right thing to do.
I just, again, I think it's interesting. I think we're going to see correlations. I think sooner or later, some of this tech stuff is going to give it up a little bit, and then we're going to see just how some of these expensive names that have had crazy runs. Let's see if people are willing to hold on to them. Let's just on the rate front, Guy. If you look at the 10-year, it's kind of having some difficulty with its 200-day moving average here. It feels heavy. You go back to that kind of June high of last year, which was like, I think it's about 3.5-ish or something like that. So this seems to be a bit of a battleground, but some of the narrative around lower rates and lower growth is also being reflected in the US dollar index, the Dixie here. And I think it's kind of interesting because it had a nice little rally in February. It was maybe a flight to quality during the banking crisis a little bit.
Giving it all back.
Yeah, it's giving it all back. Talk to me about like just kind of the heaviness of yields, the heaviness of the dollar, and then obviously that's supposedly beneficial for commodities, and we're going to talk about one commodity that you love.
Okay, so yields going lower makes sense given everything we've been talking about for weeks, and given everything that's obviously front and center today. The economy is slowing down. It's clear again when you look at the data. So yields, 10-year yields should go lower. I've said this 100 times, and you've harped on it as well. Yields going lower, or they're going lower for the wrong reasons. And if you think it's somehow bullish for equities, yeah, maybe in the textbook it is, but not in this case. So the knee jerk, I get it. People bought the NASDAQ, lower yields. It makes sense until people realize, wait a second, there's a market slowdown in what's going on. So 10-year yields, I think, will continue to go down. And if you want to play it, we talk about it all the time, you're long the TLT. And it's interesting, though, whatever the market deems to be happening, I think they're going to come to realization that in this case, lower yields are not bullish. Carter Worth has been talking that for quite some time. The dollar rolling over is interesting because historically, a weaker dollar gives a tailwind to some of the multinationals, and that clearly makes sense. But it also gives sort of, I guess, wind in the sails of the commodity market as well. So part of the reason clearly gold is going higher is because of this weaker dollar, or relatively weaker dollar, I should say. But the other reason is there's real buying out there. And we're going to look at gold in a second, as you mentioned. But a weaker dollar theoretically should provide some tailwinds. All I think that's due is mitigating some of the headwinds they face.
It's funny. We were on Fast Money last week. I think it was Thursday. Sarah Eisen, who is a great host, was filling in for Melissa Lee, obviously a great host also. And you were talking about gold, and she said, well, it's just the dollar, guy. It's just the dollar. I mean, what's your thought?
Well,
there?
I mean,
Is
it's
it that
part of
sim-
it.
Is it that
I mean,
simple?
no, it's not that simple.
Oh.
I mean, if it were that simple,
I was curious.
well, you know it. I mean, you said it to be, I know you were trying to get under my skin,
Well,
but if you look, the Chinese,
look at that. Is that cool?
Again, it is
Look at
cool.
that.
In February,
Yeah.
they announced more gold I mean, every central bank around the world right now has been buying gold. And what I've said for a while, and I believe this, people are bullish gold, people aren't long gold. Now you say, wait a second, what about the central banks? Yeah, that's not going anywhere. They're not going to be gold sales on the back of that. And when the hedge funds start to kick in, and by the way, we're probably getting close to some of the levels where the hedge funds are going to start to buy. That's when this thing, I don't want to say parabolic because but hyperbolic, but that's when this thing gets going, because they'll all come in at the same time, and the gold market is not big enough to withstand that kind of demand. So you're going to see days where gold's up $50 to $100. And by the way, you're starting to see it around the edges now.
Yeah. Well, I guess, you've been saying buy the dips, and there have been dips buy. It's been very tradable.
I don't know if we have a gold chart. I mean, we might as well pull it up. It
I
trades on the CME, as you know.
Yeah, I think we do have a gold
Look at
chart.
that.
Look at that thing. I mean, these guys, and it never even got down to that 200-day moving average, which we thought would be a good place to back and fill here. So again, I mean, like when I'm trading this and I'm trading the futures in this, you want to look at some of those levels, right, where they can, retest that high from a year ago, right, and then maybe it checks back a little bit, and then maybe you get it back towards, the high from February, and then maybe that's where you start adding if you're looking at that. Let's look at Bitcoin here too, Guy, because this is the old digital gold, this off the futures trade on CME, and look at how perfect that gap is from last June. And you saw the move. It went from like 29,000 down to about 20,000 or so. The 200-day moving average is just below 21,000. We're making a nice little flag here on this thing. I don't know, man. I kind of feel like, if the dollar firms up a little bit, and I don't see it for Bitcoin, but I know that's kind of a controversial sort of statement. And I just think that, there's other ways to reflect, kind of QE and all that sort of stuff if you want to do that.
Yeah, it's not coincidental, by the way, that Bitcoin has bounced the way it has when more and more people started talking about how this Fed's going to have to sort of take their foot off the gas. It makes sense. I don't know really what the bull case is here. I guess the bull case is a technical one. We close above 30,000, and then maybe we're off to the races. But, this mean reverts historically, and my sense is they'll do it again. I think you're going to have a better entry point. If I'm trading it, though, I think here you're waiting for a close above 30,000. Maybe you get long on a breakout. Otherwise, you're waiting for a pullback, I think. I don't know if it gets down to that 21,000 level, but maybe 25,000, and that's a more interesting entry point.
Yeah. No, well, I guess. I mean, I can't even think of like a good reason, especially when people have like $1 million price targets out there for 90 days out.
Yeah.
It just seems like kind of goofy here. All right, before we get out of here, let's hit a couple single names. And this, I think these two names are really important from a sentiment standpoint. Obviously, we like talking about Tesla for a whole host of reasons, but I think this one's kind of interesting. It didn't get to its 200-day moving average. We talked about Tesla yesterday, those deliveries that they had in Q1 and the production numbers. It fell short of expectations, both by consensus on the street and also the company's guidance. And if you look at this thing, that $200 level, you see the red line there. It's just below that 200-day moving average. So lots of things going on with 200 there. You see that uptrend. It seems kind of steep. It's actually lining up with the 50-day moving average. So it's testing there. If we get below 190 today, and I think it's trading around 191 and a half or so, that's why these lines are important. We talk about stops in the futures market. There's a lot of people who are looking at a lot of the same levels on charts. They actually use the charts to help inform option strikes, that sort of thing. So, there's obviously inverse ETFs in this thing. There's a lot of things going on. So I think the technical levels are really important. So let's see how that thing holds at that number. Any thoughts there? Because yesterday you thought, okay, I see a back and fill to 165. That was the low last month.
And I think, look, the fact that we just rallied off that 165, but failed to get to the levels we saw in February, which I think we topped out around 218. I think if you're bullish, you have to at least have some sort of pause here. And if we were to break this very short-term uptrend that we've been in since the beginning of the year, I think you have to say to yourself, okay, that 165 level is in play. Then you have to have a much different conversation. By the way, although people have gotten themselves all excited about Tesla, which I totally understand, you're still talking about a stock at these levels. It's 50%, actually more than 50% off its all-time high. So the fact that we've rallied 100% off the lows is interesting. But in the broad scheme of things, we have seen bounces of this magnitude before. So you can make an argument that we are just in a continuation of a pretty significant downtrend that's been in place for quite some time.
Matter of fact, right? The last one you highlighted this, and I thought was interesting. I didn't even see any headlines about it. I didn't see any news, but this is Caterpillar, Cat Tractor. And again, we talked about some of the resource. Well, I don't know if we did talk about it right now, but some of these resource names are getting absolutely killed today. Energy stocks are giving a bunch of yesterday's gains back. And then when you look at, the transports and you look at some industrials like Cat and the way it acts today, Larry McDonald of the Bear Traps report had to tweet out earlier just saying that some of the weakness in some of these names is kind of flashing recession fears, and we've been talking about that. So give it to me on Cat. You thought there was a big double a few weeks ago, huh, Guy? In the Cat.
Well,
and the beer?
It's interesting if you look at this stock. I mean, we traded down, we held the moving average, so it looked as though we didn't necessarily fill that gap, but it felt like it was going to party, and it did for about a week and a half, and now here we are again. But if we were to break the 200-day moving average now, one has to think we're going to fill that gap, which probably comes in just around $200 or so. If you look, you can see from October into November. That to me is interesting. But to your earlier point, I mean, this is a very economically sensitive name, and it's obviously doing something today for a reason. My sense it's on the back of the ISM. I didn't see any other news, but if Cat starts to roll over Deere, names like URI, some of these other names, that's got to be concerning.
Well, as Amanda Diaz named this episode, the ISM Hangover, there was no shortage of takes how there's no way to kind of sugarcoat these 5 consecutive prints below 50 for the ISM and what that means. I think we had Jim Bianco, some of his research yesterday at Market Call. He's going to be on Fast Money today with us at 5 for a brief comment. Just last thing before we get out of here, because I just don't think we can put too fine a point on this. Keep an eye on Schwab, that $50 level. The KRE, the KBW's regional bank index is also just kind of melting here. And look at some of those names. Blackstone, which we spent some time on yesterday, I think it was down 5% at 1 o'clock when we were doing market calls, down another 4% today, Guy. $80 level, I think kind of important. We highlighted the fact that the pre-pandemic high was 65. Look at all these life insurers. Like, what the hell is going on with LNC?
Yeah,
and
we've
been
talked about that
it
for a while. I'll probably have to do another show on that, but we mentioned life insurers on our show, and we've done it on Fast Money as well. I mean, they obviously are not impervious to what's going on with rates and stuff and some of this banking. So we'll see. None of this is particularly encouraging. It's old news that's out there, and it's not just us saying it. When you hear someone like Jamie Dimon talking about this, I think for me at least, it reinforces that we're not that far off the track here, Dan.
I agree. Sorry, guys, we can't be a little bit more optimistic. The thing that we've been kind of optimistic about is just the look and feel of the NASDAQ, and it broke out. But that being said, it's not something from a fundamental standpoint I think you and I want to get behind right now. And I think we're going to have a lot more clarity over the next few weeks. But everything under the hood, man, just does not look particularly good for stocks. You think about where the stock market is right now, off of the lows and up on the year. I feel like, you know what, a post-earnings malaise in the stock market, put a little fear. Let's get that VIX up to 24 or something like that. Let's see some stability in the dollar, some stability in rates, maybe some plateauing of some of these decelerating economic data. Price it in. If you don't price in the worst case outcomes, not even the worst case, like kind of the base bear case sort of outcomes, then valuations are just not something that you want to kind of stick to.
I agree. Listen, we got to hop here. We're back tomorrow.
Yeah,
I think Carter Braxton
Worth CBW
will be joining us. I'm sure he's got some
Give us
wonderful
some feedback on this whole new look and feel that we got going on here.
Me or the people?
No, not
the
you.
people.
Yeah, we're trying some new things here. We're getting our studio in shape. You know what I mean?
Subscribe to the YouTube channel. Smash the shit out of the like button. Make comments on whether you like this or not. I mean, we have this studio, so we might as well use it. I want to thank CME Group, where risk meets opportunity. Obviously, our data provider is FactSet.
Yeah, it is.
Back tomorrow with Carter Braxton Worth. Enjoy the rest of your day. We'll be on the Fast Money later tonight.
5 o'clock Eastern.
5 o'clock Eastern.
See you,
Set your watches.
Thanks a lot.